In 1755, a French-Irish economist named Richard Cantillon died under mysterious circumstances. His London residence burned to the ground. His body was never conclusively identified. The official record states murder by a disgruntled former servant. Some historians suspect he staged his own death and fled to South America. What is not in dispute is what he left behind: a single manuscript, published posthumously, titled Essay on the Nature of Commerce in General. Within that manuscript is an observation so dangerous to the established financial order that it was effectively buried for 250 years. It has no official name in most economics textbooks. It is not taught in standard university curricula. It does not appear in Federal Reserve policy papers or in the published minutes of any central bank meeting. Yet this single observation explains, with surgical precision, why the largest monetary interventions in human history, the trillions created since 2008, made the wealthy dramatically wealthier, while the average wage earner fell further behind. The observation is now known as the Cantillon effect, and it is operating at a scale its author could not have imagined, redistributing wealth in real time through a mechanism so fundamental to the modern monetary system that acknowledging it publicly would call into question the legitimacy of every central bank decision made in the past 2 decades. What Cantillon observed in the early 1700s was deceptively simple. When new money enters an economy, it does not arrive everywhere at once. It enters at a specific point. It passes through specific hands first, and those who receive it first benefit at the expense of those who receive it last. This is not a theory about inflation in the aggregate. It is a theory about the sequential distribution of newly created money and the winners and losers that sequence creates before prices have time to adjust. In Cantillon's era, the entry point was literal. Gold and silver flowed into Spain from the Americas. The Spanish crown spent it first, on military campaigns, court luxuries, and debts to foreign bankers. Merchants who served the crown received it second. By the time the new money filtered down to common laborers and farmers, prices had already risen to reflect the increased money supply. The laborers received the same nominal wages, but faced higher costs for bread, rent, and cloth. The crown and its bankers had purchased goods at the old prices. The workers purchased the same goods at the new prices. The transfer was complete before the workers understood it had occurred. The historical parallel that makes this observation urgent, rather than academic, is the monetary response to the financial crisis of 2008 and, more dramatically, to the global pandemic beginning in 2020. Between September of 2008 and March of 2020, the Federal Reserve, the central bank of the United States, expanded its balance sheet from approximately $900 billion to roughly $4.2 trillion through a series of programs collectively known as quantitative easing. Then, in the 12 months following March of 2020, the Federal Reserve added an additional approximately $4.5 trillion, nearly doubling its balance sheet in a single year. The European Central Bank pursued parallel expansion. The Bank of Japan continued its decade-long program. The Bank of England, the Swiss National Bank, and the People's Bank of China all engaged in some form of extraordinary monetary creation. Globally, central banks created an estimated approximately $11 trillion in new money between March of 2020 and December of 2021. $11 trillion. The question that Cantillon's 300-year-old observation forces us to ask is brutally specific. Where exactly did that money enter the economy? Whose hands touched it first? And what had they already purchased by the time it reached you? To understand why the entry point matters, consider how money creation is supposed to work in a textbook model. Think of the economy as a bathtub. The central bank controls the faucet. When the economy slows, the bank opens the faucet, creating money, lowering interest rates, making credit cheaper. The water fills the tub evenly. Everyone benefits simultaneously. Employment rises. Wages increase. Prices adjust gradually and uniformly. When the economy overheats, the bank closes the faucet. The water level drops evenly. This is the model taught in introductory economics courses. This is the model implied in every Federal Reserve press conference. The chairman or chairwoman stands at the podium and discusses monetary policy in aggregate terms: total employment, overall inflation, gross domestic product growth. The implicit assumption is that monetary policy affects the economy uniformly, like water filling a tub. Cantillon's insight destroys this assumption. The bathtub does not fill evenly. The faucet has a fixed position. The water hits one spot first. It pools there. It spreads outward slowly, and by the time it reaches the far end of the tub, the near end is already overflowing. The question is where the faucet is pointed. In the modern monetary system, the answer is documented and specific. The first anomaly is the mechanical pathway of quantitative easing. When the Federal Reserve creates money through quantitative easing, it does not mail checks to households. It does not distribute currency through the banking system to individual depositors. It purchases financial assets, primarily United States Treasury bonds and mortgage-backed securities, from a select group of financial institutions known as primary dealers. There are approximately 24 primary dealers designated by the Federal Reserve Bank of New York. These are the largest banks and securities firms in the world: J.P. Morgan Chase, Goldman Sachs, Bank of America, Citigroup, Barclays, Deutsche Bank, and others of comparable scale. The newly created money enters the financial system through these institutions first. They are the point of contact. They are Cantillon's first receivers. These institutions do not hold the cash idle. They deploy it. They purchase additional financial assets: stocks, corporate bonds, real estate, private equity positions. This purchasing activity drives up the prices of those assets. The owners of those assets, who are disproportionately in the top 10% of the wealth distribution, see their net worth increase before a single dollar of the new money has reached the broader economy. By the time the monetary expansion translates into job creation, wage increases, or consumer spending, a process that takes months to years, known as the monetary transmission mechanism, asset prices have already adjusted upward. The first receivers have already locked in their gains. The second anomaly is the empirical evidence of this transfer, measured in real time. The Federal Reserve publishes a quarterly report called the Distributional Financial Accounts. This dataset tracks wealth by percentile over time. Between the first quarter of 2020 and the fourth quarter of 2021, the period of maximum monetary expansion, the net worth of the top 1% of American households increased by approximately $10 trillion. The net worth of the bottom 50% increased by approximately $1.5 trillion. In proportional terms, the top 1%, who already held roughly 32% of total household wealth, captured approximately 70% of the wealth gains. The bottom 50%, who held roughly 2% of total wealth, captured approximately 10% of the gains. These are the Federal Reserve's own numbers, published on its own website, in its own dataset. The Cantillon effect is not a conspiracy theory. It is a measurable outcome, documented by the institution creating the money, that shows a consistent pattern of first receiver advantage operating exactly as a 300-year-old manuscript predicted. The third anomaly involves the housing market as a Cantillon transmission channel. Mortgage-backed securities constituted a significant portion of Federal Reserve asset purchases. By buying these securities, the Fed drove down mortgage rates to historic lows, below 3% for a 30-year fixed mortgage during parts of 2020 and 2021. These rates were available to anyone who could qualify. But qualification required existing assets, a down payment, a strong credit history, existing equity for refinancing. Homeowners who already held property refinanced at lower rates, reducing their monthly payments and freeing up capital. Institutional investors, private equity firms, real estate investment trusts, and asset management companies like Blackstone accessed even cheaper capital through commercial lending facilities connected to the same monetary expansion. They used this capital to purchase single-family homes at scale. Blackstone's real estate fund acquired tens of thousands of residential properties between 2020 and 2022. First-time buyers, predominantly younger, less wealthy, and lacking existing equity, faced a market where prices were being driven upward by buyers with access to capital they could not match. The median home price in the United States increased from approximately $270,000 in early 2020 to approximately $410,000 by late 2022, a rise of over 50% in approximately 2.5 years. The money entered through mortgage-backed security purchases. It flowed to existing asset holders and institutional investors first. It raised prices before reaching the population of aspiring first-time homeowners. By the time it reached them, the asset was already repriced beyond their reach. The fourth anomaly is the stock market response and its distributional implications. The Standard & Poor's 500 index fell to a low of approximately 2,200 points in March of 2020. By December of 2021, it had risen to approximately 4,800 points, more than doubling in less than 2 years. This recovery was not driven by a proportional recovery in corporate earnings, employment, or economic output. It was driven primarily by the suppression of interest rates and the flood of new money into financial markets through the primary dealer system. According to the Federal Reserve's survey of consumer finances, the top 10% of households by income own approximately 89% of all stocks. The bottom 50% own approximately 1%. A doubling of the stock market, therefore, represents a near doubling of financial wealth for those who were already wealthy, and a statistically negligible change for those who were not. The Federal Reserve's stated purpose for quantitative easing was to support broad economic recovery. The measured outcome was a doubling of stock prices that benefited primarily those who least needed the support. The gap between stated purpose and measured outcome is the Cantillon effect operating in real time at the largest scale in monetary history. The fifth anomaly concerns the timing of insider financial transactions relative to Federal Reserve announcements. In September of 2020, the Federal Reserve's Inspector General opened an investigation into personal financial trading by senior Federal Reserve officials. The investigation revealed that Robert Kaplan, president of the Federal Reserve Bank of Dallas, had made multiple individual stock trades valued at over $1 million each during 2020, a year in which the Federal Reserve was making decisions that directly affected asset prices. Eric Rosengren, president of the Federal Reserve Bank of Boston, had traded in real estate investment trust securities, while the Federal Reserve was actively purchasing mortgage-backed securities that directly supported real estate valuations. Both officials resigned. But the deeper structural issue was not individual misconduct. It was that the people making monetary policy decisions that determined which assets would rise in value had the ability to hold and trade those same assets. They were Cantillon's first receivers in the most literal possible sense. They knew where the money would go before it went there, because they were directing it. The sixth anomaly is the global synchronization of this effect across central banks. The European Central Bank's Pandemic Emergency Purchase Program created approximately 1.85 trillion euros in new money. This money entered the Eurozone financial system through a similar primary dealer structure, large European banks serving as counterparties. The Bank of Japan expanded its already enormous balance sheet past 130% of Japan's gross domestic product. The Bank of England purchased over £450 billion in gilts. In each jurisdiction, the same pattern held. New money entered through financial institutions. It flowed into asset markets first. Asset prices rose before consumer prices. Owners of assets benefited before workers and consumers. The Cantillon effect operated identically across every major currency zone, not because of a coordinated conspiracy, but because the mechanical structure of modern central banking ensures that newly created money will always enter through financial intermediaries and will always reach asset markets before labor markets. The effect is not a bug. It is an inherent feature of the transmission mechanism itself. Two interpretive frameworks present themselves. The first is structural inevitability. Central banks have no mechanism to distribute newly created money directly to households. Purchasing financial assets through primary dealers is the only operational tool available. The distributional consequences are regrettable, but unavoidable. The cost of preventing a deeper economic collapse. Inflation, when it eventually arrived, affected everyone and was subsequently addressed through interest rate increases. The system worked imperfectly, but functionally. No alternative was available. The second framework follows the incentive structure. Central bankers are drawn from the financial sector. They return to the financial sector after their public service. Their social networks, professional relationships, and personal financial portfolios are concentrated in the asset-owning class. The policies they design naturally benefit the institutions they understand best and the asset classes they personally hold. The Cantillon effect is not an accident. It is the predictable output of a system designed by first receivers to benefit first receivers. The revolving door between Goldman Sachs, the Treasury Department, and the Federal Reserve is not a conspiracy. It is an organizational chart. The evidence distinguishing these frameworks exists in specific records. Federal Open Market Committee transcripts, published with a 5-year delay, contain the internal deliberations about policy design and distributional awareness. Federal Reserve financial disclosure forms, now enhanced following the trading scandals, show the asset holdings of decision-makers. The distributional financial accounts show the outcome in granular detail. The primary dealer transaction records, reported to the Federal Reserve Bank of New York, show the exact flow of newly created money into specific institutions. The silence from global institutions is notable but structurally explicable. The International Monetary Fund has published working papers that reference distributional effects of monetary policy. The Bank for International Settlements has published research explicitly noting that quantitative easing widens wealth inequality. The European Central Bank's own research department has produced papers acknowledging the asset price channel disproportionately benefits wealthier households. These publications exist in the academic layer, accessible to specialists, invisible to the public. No central bank governor has incorporated these findings into a policy-setting press conference. No Federal Reserve chair has stood at the podium and said that the monetary action being taken will disproportionately benefit the top 10% of the wealth distribution. The information is generated internally, published in technical formats, and excluded from public communication. The gap between what institutions know and what they say is the space in which the Cantillon effect operates most effectively. Richard Cantillon wrote his observation 300 years ago. He described a world in which those closest to the source of new money benefit at the expense of those furthest from it. He was describing 18th century Spain and France. He was describing gold flowing from colonial mines through royal treasuries to courtier merchants, while farmers paid inflated prices for bread. The mechanism has not changed. The scale has. In March of 2020, the Federal Reserve created more money in a single month than existed in the entire global economy during Cantillon's lifetime. That money entered through 24 primary dealers. It flowed into stocks, bonds, and real estate. It raised the net worth of the already wealthy by trillions before a single stimulus check reached a single household. The stimulus checks, $1,200 per person initially, arrived weeks later. By then, asset prices had already moved. The first receivers had already positioned. The sequence was complete. 3 centuries ago, a man described a law of monetary physics. That law states that the creation of money is never neutral. It always benefits some at the expense of others. The benefit flows to those closest to the point of creation. The cost is borne by those furthest from it. Every central bank in the modern world operates a system that confirms this law with every act of monetary expansion. Not one of them includes this distributional reality in its public mandate, its official communications, or its policy framework. The law is 300 years old. The evidence is measured in trillions. And the most unsettling question is not whether the people operating the system understand the Cantillon effect. Their own research papers confirm that they do. But what it means that they have built an entire institutional architecture around the principle that the public should never be told where the faucet is pointed.